Hello, everyone. A warm welcome to our Net Zero webinar series. Today, we will be discussing on the topic on how from net zero signals to market adaptation, how clean tech solutions win or loses in the go-to-market battle. I am Isha Gupta Vagnare. I am CEO of EV Academy. We have been interacting with all of you for a long time now through a series of webinars focusing on net zero, decarbonization, and energy. P-Manifold EV Academy is a organization dedicated in providing training and certification programs globally in the area of decarbonization, e-mobility, net zero, and clean energy. And we regularly conduct this type of a webinar series in order to engage with the audience, in order to engage with the industry, and build this ecosystem in which we are talking about things that really matters when we are talking about our commitments toward the planet, towards the planet, people, and profits. For the today's series, in our past discussions, we have seen how net zero commitments, climate change regulation, standard public procurement policies are increasingly reshaping how the market functions. There have been a strong demand creation when it comes to clean tech solutions, be it across energy, mobility, manufacturing, or supply chain. Globally, large companies have announced net zero targets covering over 90% of the global GDP, while instruments such as carbon pricing, clean procurement mandates, the CBAM trade measures which are coming up, and sustainability disclosures requirements are accelerating interest in low carbon technologies and solutions. However, while policy signals are very strong when it comes to clean tech solutions market adoption, we have seen there is a lag. There is a lag either when a lot of clean tech solutions are stuck at the pilots, or they come in but they really don't scale up. So in many cases, solutions, we have observed that solutions are built around policy opportunity, but they don't really actually focuses on the buying logic of corporates, utility, or public agencies. So one, what are the consumer pain point are you really trying to solve? How are the market policy alignments taken into consideration? How do you scale and invest into these clean tech solutions? What is the readiness? How do you bridge those gaps? Are few of the key areas which we would be discussing into this webinar. We have a very interesting lineup of panelists with us today. Each one of them is coming from a very different background, different geographies, and also across the value chain of the clean tech solutions. So our first panelist is Chetan Sakharkar. He is a manager in ESG and climate change with PwC. Chetan is a sustainability professional with more than a decade of experience in ESG advisory, climate risk, and corporate sustainability. Our second panelist is Vinod Balakumar. He is a senior counselor with CII, and he brings in about 15 plus years of experience across industry, policy, sustainability initiatives, and has played a key role in enabling ecosystem readiness for scaling clean technologies in India. Our third panelist, Paolo Azurin, is joining all the way from Philippines. He is a president and CEO of CLSA Exchange Capital, with a global finance leader with more than 20 years of experience across capital market, investment banking, and energy transition finance. Prof. Paolo leads CLSA Exchange Capital, focusing on strategic investments and capital deployment across emerging sectors in Southeast Asia. He is also an adjunct faculty with Asian Institute of Management and IIM Kashipur. The fourth panelist is Karthik Vahi. He is a co-founder and director of Claro Energy Private Limited. He is a clean tech entrepreneur with more than 15 years of experience in renewable energy and decentralized solar solutions, delivering solar power solutions across agriculture, telecom, and rural sectors. A very warm welcome to our esteemed panel today. Now to start with the discussion, Chetan, I would like to start with you to understand how this clean tech space is really evolving. What are the innovation, customer pain point, and solution designs? And my question to you would be really, what problem clean tech innovations are actually solving and for whom. Are these solely policy driven? Are these compliance driven? Or customer pain point, market signals? All these factors come in together when you are looking into the clean tech solutions available in the market.
Right. So I think clean tech solutions are problem solving two to three problems here critically. So one will be cost and efficiency problem, right? That's the primary driver. That's what we are seeing. So energy cost reduction, operating cost expenses reduction, is a key lever, and that's why you see companies, even if they don't have any net zero or a GHG reduction roadmap, even they are started deploying renewables, let's say, right? Because it is helping them to reduce their operating cost expenses, which is very key element and driving down from their finance verticals. Fuel switching, right? You have DG set replacements, now you have gas alternatives, heat pump deployments. So all of these levers are widely available and it is getting adopted. Of course, with the nuances that it should not hamper plant production reliability, etc. Maintenance nitty gritties, all of that is taken care of. uh, Second will be compliance and risk problem. So that is, I think, fastest growing focus. Carbon reporting, let's say scope 1, 2, 3 disclosures, so industry and peer performance and peer companies are acting as key levers here. Of course, regulations like CCTS, CBAM, all of them are driving forces here. And ESG disclosures, where which is majorly driven by investors, analysts, regulators, let's say large buyers. So this is from the compliance and risk problem, which is clean tech is solving. And third will be, I think, market access and revenue problem. So export eligibility, like you said, carbon based entry barriers like CBAM. So this will be a year one of CBAM financial implications. So we see a lot of clients in India with lack of clarity in terms of approach to be adopted, in this critical phase, because next year the financial liability will start. Okay. And second key point here, in this will be supply chain requirement. So a lot of your big clients based in EU and US are driving down their net zero requirement because you fall under their scope 3. Especially in pharma, let's say, they have bold targets, given to the suppliers in India, 28, 30, at least 50% reduction is what we are seeing. So you lose contracts, right? So clean tech is becoming a license to sell. It's just not a sustainability choice. That's what we are saying. And from supply side, I think it is evolving in 2, 3 ways. So shift from pure technology to a business model. So earlier, OEMs used to sell equipment or tech. Now we are seeing bundled solutions like energy as a service, or pay per use. So that's why we are seeing green captives. VPP is also a form of renewable arrangements clients are looking at, right? And second will be increasing focus on integration and deployment. So it's just not standalone innovation like earlier, but now plug and play, retrofit friendly. For example, battery energy storages, we're seeing massive demand here from clients. A lot of clients are exploring this because it is a plug and play solution for them, and with a lot of operational flexibility to integrate many of their systems. So this is what the picture looks like.
Thank you so much, Chetan. And it is really correct when we say that it's no more a choice. You have to follow it because either the compliance is forcing you, your customer, or your market is demanding it, or in order to sustain the market you are competing in, it's the basic bare minimum requirement that you are compliant, that you are sustainable, that you are making the right choices without harming the planet. This takes me to Vinod. Vinod, when we are talking about demand from the energy efficiency area where you are working around, uh, what what are the drivers or limit when it comes to the you know what drives or what limits the conversation of policy signals into real buying decisions? What are the implementation challenges which you are looking into the ground when you're talking with, say, MSME or organizations? Or at a national level, what are the signals you're seeing?
Yeah, I think that's a valid question. I think you introduced me, but I would like to briefly touch upon the work what I do, so that then I can come back to the question what you asked. I work for CII with the Green Business Center based in Hyderabad, in India. We do the work related to the energy audits for different industries and different sectors, and we also have a wing for CleanTech startups, wherein we connect the startups with the industry. So that is our main forte of work, what we do in CII, in GBC. So we have been working with CleanTech startup for the last 10 years. The clean tech startups in per se, who are making the innovative technologies, which is the need of the hour of the industry, we handpick them and we map it with the industries and we arrange the meetings, and then finally we make the implementation. So that was our work, and recently we have started funding these startups which are innovative, and we have a panel of jury who evaluate those technologies and make the technologies implemented. So these are the some work we do. And secondly, we also have the validation of clean tech startups. So the question you asked, how these startups are not able to reach to the industry, is something the pain point lies here. The clean tech startups are not validated. Their technologies not reached to the industries. At least it is not given in the language what industry wants. So that is one limiting factor. So we do a validation of that particular technology with our experts of the engineers and auditors. They do go to the physical site and do the actual measurement and quantify the savings. And report is given to the industry, so that that decision making process is made very easy. We do the clean tech validation. And lastly, we also have clean tech mapping, wherein we go to the industry, identify the problem, what industry is facing. For example, you go to a boiler. What are the technologies currently available and what technology is lacking? Then we map that requirement with the clean tech startups. We connect each other. So we do the clean tech mapping. So these are the variety of surveys we do. When it comes to your question on why this energy audit, I mean, energy audit is something every industry is mandatory to do in every 3 years as per the compliance of Bureau of Energy Efficiency, of course, who are designated consumers. But if you see the actual real-time implementation, when we do the energy audits, we recommend say 100 projects. Out of 100 projects, the plant may implement only 20 or 25 projects. So the reason behind this is, one, there could be operational issue. The plant may expect the better ROI. Second, thirdly, they need a proven solution. So they don't want to take any risk in implementing some of the technology, which is at the cost of operation or cost of the cost of production. So they look at the minimum risk. So this is where the CII comes in. So we do the validation of particular technology, and we make sure that the energy savings or the resource saving what they are going to achieve, we will validate and give them as a report with backup calculations. Then they have confidence in implementing it. So this is what we do at CII, and with this way we are working very well. And we have now 550 startups who are well connected with us, not only from India. We also have a startups from Sweden, Australia, Japan, several other countries, and now we are working with Canada and United States. So I think these are the major limitation. I think put you in one summary, one line. The startup needs support to reach out to industry right people, and with required the backup support for validation. And industry also need support for mapping the technology with the startup. If both the things are resolved, then I think it will be easy for the scaling up the clean tech startups for the implementation. Yeah.
That's a very valid thing. Like when we have the validation, that confidence of going to the market, understanding who would be the real customer becomes little easier, little doable. And second, I think when we are going to financiers who would be funding us, that also gives kind of an assurance to the funders that, okay, this is a technology that has been vetted and that has a, kind of a backing from a renowned institution. And that takes me to you, Prof. Paolo. When we are talking about scaling up a solution, as an investor, what are the two or three top things as a decision maker who is a funder or provider would look into when scaling to a solution? How much weightage would you give to technical performance versus real world reliability versus its component towards net zero decarbonization?
Right. Well, my view here is it doesn't really differ much from the way investors evaluate other emerging technologies or other projects. No? So you're still looking at the applicability to scale, unit economics, and capacity. Um, on top of the net zero targets or net zero goals that the technology aims to achieve. No? Now, one of the things that's very important to scale though is funding, and I think that's the key consideration or one of the key drivers of companies or projects getting over the chasm, so to speak. So really, funders, investors, lenders are looking at cash flow predictability. So this would include anything from tariff rates, guaranteed contracts, who your counterparties are. So in the Philippines, and much of Southeast Asia, where most of the clean tech companies are primarily involved in renewable energy. Funding is readily available for companies that have offtake agreements or have won in the renewable energy auctions where the rates are already determined. No? So if you're a funder, that solves a lot of things, right? Because you can figure if you know the tariff, then you know the capacity, then you kind of have a reasonable estimate of the cash flows already. Because in the end, it's one thing to meet the net zero targets. It's another thing to get your money back. So I think that's quite important. No? So one thing that I just like to point out, no, in the Philippines, say for example, there are different tariff mechanisms. So we now have a green energy auction program where potential projects bid out a certain rate, no? And they typically bid a certain tariff that would meet their cash flow requirements, including servicing the funding, no? So that's worked out pretty well for a developing renewable energy market like the Philippines. I understand this is one of the more advanced jurisdictions for that. In other countries, they're still fit. Other countries are just largely market determined. No? So it's really about predictability of cash flows, no, for companies or projects to scale up. No? Yeah.
Thank you so much, Prof. And I think it is important to understand, like you mentioned, that certain solution or technology is working in the Philippine market, but not necessarily would pick up in some other market. And that subjectivity would always be there. It could be the incentive, policy support, market, how the market is evolving, consumer behavior, which makes a technology adopt or fail. I would like to invite Karthik here. Karthik, given you're coming from an entrepreneur background to have worked onto solar-based solutions around, why do some clean tech solutions succeed in real-world adoption, even in the price-sensitive markets? Like Philippines would be one of the price-sensitive markets, while others fail despite there is strong policy and funding support. So, what are your experiences when coming up with these innovative solutions into the market as an entrepreneur?
Yes, thanks, Isha. Happy to share my 2 cents on this. The only a precursor to my answer would be that we're a technology agnostic services company in some sense, right? The industry term for us is a system integrator. So in that sense, we're not wedded to just the photovoltaic technology or even a particular battery chemistry when it comes to energy storage. I mean, if there's a viable technology out there, we are probably a good go-to market partner for that technology, and in that sense, taking that solution to the end user. So, in that sense, my view on this could be fairly unbiased, uh, and more from the lens that at the end of the day, the business model has to make sense. So, I'll give you a case in point. Now, yes, on paper, we do a lot of solar irrigation pumps, right? Which is solarizing existing bore well pumps, which are either running on grid electricity or on diesel. And we, of course, operate them using solar. Now, the unit economics, even for a farmer without any incentive support, is still fairly compelling. Like one could argue that a 3-year, 4-year, 5-year payback is compelling economics, right? But that said, it still is not enough, particularly in the early stages of the adoption cycle of a new technology, for the people to find comfort that, yes, this is a worthwhile technology for me to invest into, right? So, in that sense, in the earlier part of the adoption life cycle of solar irrigation pumps from a consumer lens, the government really had to throw its weight behind in terms of incentivizing them with capital subsidies and so on and so forth. Now, of course, oftentimes it's not a vanilla way of thinking. The government also sometimes tends to be populist, so that's another incentive. But I think largely the intention is that, okay, can we stimulate enough early demand for this solution or intervention or technology, clean energy, to find its own 2 feet and kind of become self-sustainable. So in that sense, that has, and what we've seen is over the years that subsidy number, at least in some categories, comes down, right? In fact, a better example for that would be solar rooftop solutions, right? So I think when they started back in the day, they were massively subsidized. Now, present day, the market is actually flourishing, and the subsidy is actually really limited to a very small size of the system, up to 3 kilowatt only, right? So if you're a large consumer, you don't get a subsidy benefit. Yes, of course, you do get the benefit of net metering, which means you can export your surplus power into the grid and so on and so forth. So long answer to a short question is that at the end of the day, the business model, with or without policy intervention, has to make sense. And for a company like us, which is a for-profit company, which is not married to a particular technology or an innovation, uh, as Professor Paolo said, it really boils down to cash flows, right? We have a certain, weighted average cost of capital, which is a blend of equity that we have raised, equity capital and debt, and we need to kind of deliver a return which is higher than that, right? So if a particular business model supporting a particular technology fulfills that condition for us, we lap it up and we try and double down on it. If not, of course, we ignore it. And in that sense, we're a critical link in the chain because we are the folks who are taking these technologies to the end consumer and integrating it on site. But that's from our lens. But I hope it answers your question to some extent.
Yes, it does. End of the day, everyone have to understand what is working, what is not, and what they can sustain for a longer term. A very anything which is too much of charity, but we cannot make it viable, then it's not going to work neither for us and even for the customer. One time buy would help, but eventually it's not a viable solution. So definitely we will have to look into, okay, what is working in the market, is there a right market, is it helping with the right solution, else we just roll it back. So I agree with you, it definitely makes sense. I have an open question for the forum, anyone who wants to take this up. A lot of time when it comes to sustainability and when we're talking about clean tech solutions, a lot of time the solutions are really useful for the learners, but for the consumer, right? Like it could be somewhere focusing on MSME or somewhere focusing for the farmers, but financially they are not viable. What are the way out? Is there a way through which funding can be taken, through which organizations would give a higher valuation to it, and still these products can be brought into the market?
Maybe I can take a stab at that, no, Isha. based on a transaction that I've been working on. So in this case, it's electric mobility, EV mobility through buses. So no question, as you mentioned, consumers find the solution good, right? The configuration of the EV buses that the company uses is just right for a developing country like the Philippines with all its traffic considerations, the weather considerations. The solution does address many pain points. The question then becomes, how do you monetize? No? Because as you said, that the customer feels it, but yeah, there's that value. You know there's value creation. The second part is, which is more difficult, is value extraction. So that the journey of that company in particular involved several iterations of trying to come up with business models that would create value, that would extract the value, no? Um, the initial model was as a mass transport system, which is what you kind of have every day in India or anywhere else, where if you ride, you pay. Apparently, that doesn't work because there are regulations and licensing considerations. You have to get a franchise, that sort of thing. So that model fell apart rather quickly. So your value extraction model failed. So the good thing is the company was able to pivot into something else using the same, addressing the same pain point of mobility. They're now implementing a model of shuttle services where the payer, or the one who basically pays for the rides, or let's say the BPO companies that have employees that use these buses. So they pay in bulk for everyone in the company to use the EV shuttles. So if you notice, it's the user isn't the one paying, it's the employer. And that works for them because, going back to my first point, um, funders will typically ask for certainty of cash flow. So on the old model was, the cash flow was uncertain because now you would have to have a good idea of foot traffic and ridership and whatever, and the rate, and it's a regulated rate. As a private shuttle company using EV buses, you have a guaranteed contract. So the company was able to get these contracts, go to the funders and say, look, here it is. This is how much we're gonna get. And the funders say, okay, you're working with a legit multinational, we can take value in that contract and give you some funding. So it goes back to, I guess the short answer is, trying to figure out how to extract value, trying to get that value uh certain, and then that kind of gets you to a position where you can scale, right?
Yeah, that actually makes sense. Like, who is my consumer versus who will pay for it? That clarity would be needed. Even if we are going to a market with a solution, who it could be a third person who is actually putting money in it, like the jeepney example which you gave. So, what are we selling and how are we making it economic? Who is the l- decision maker for that economic viability? Maybe that is the person we really have to find and reach out. My next question would be to you. You talked about helping the startups, connect with the business, give them validation, and help them come to the market. But you also shared a number in which, while there are big number of applications, real conversion is low. Where do you see this biggest mismatch today between the startup build and what industry would really buy or consumers would really buy?
Sorry, is it that me, Isha?
Yes, Vinod.
Okay, sorry. So I think the point what I said on the validation part, what I personally feel, so industry is all not able to get the right pick of technology now. So, for example, you go to the steel industry, and the steel industry require technologies related to reducing the carbon emissions and reducing the electricity consumption in some of the process area. For example, you talk about the DRI process, wherein the DRI process require. I mean, currently the process of DRI is to utilize coal as well as iron ore to make the sponge iron. But when you see the current level of technology, we don't have technology to reduce the coal consumption, which is the biggest emitter of in the process. So what ideally we are looking at is we are looking at having some alternate technologies. For example, can we inject hydrogen? But for manufacturing the steel. So, I mean, we are looking at that aspect. So really, we need some kind of scalable technologies which can be potentially implemented. For example, having the green hydrogen burners and converting because the right now the kilns are designed in such a way they cannot use hydrogen. So how can we have integration of hydrogen in the existing ecosystem? So which is really a pain point for the steel consumers. And as you know, the green steel taxonomy is in the place, and wherein the consumer, wherein the steel manufacturer can able to have their steel certified for the green steel. So which is certified by the Ministry of Steel by the Government of India. So right now there is a competition created in the market wherein steel consumer has to go for the green steel certification. Otherwise, there won't be any procurement from the consumers. Okay, so by which there is going to be a bigger demand to reduce the carbon emission. Right now, they are talking about 2.2 ton of carbon dioxide per ton of crude steel is the limit for which you can get the green steel certification. So, and while this is in place, and the top of it, there are some carbon mechanism which are getting built up. Bureau of Energy Efficiency is giving a target to reduce the carbon emission to the industry. So within 3 years, they have to reduce the carbon emission by 10% as 20% as per the limit what they have emitting it. So this has become the pain point for the industries to go for really looking for more technologies to implement and reduce the carbon emissions. So wherein all these clean tech startups, they play a bigger role to help these industries to meet the targets, meet the market requirement, meet the public, even the government. Right now, if you see, the government is imposing 25 percentage of the procurement for the public procurement should be on the green steel. So, I mean, there are different, even the automobile players will have some stringent target to reduce the, to have the consumption of steel with recycled steel. So, there are several mechanism in place, so which will definitely have more and more opportunities for the clean tech startups to come and play a bigger role in future.
Thank you, Vinod. I see again that there is a policy push, there is a incentives, but I have a question which we usually see when we talk about green products, both to Karthik and Chetan. So Karthik, from an entrepreneur hat, you can share your inputs on this. Chetan, from the advisory hat, do share your views on it. We have been talking about a green premium a lot. So whenever any, be it steel, be it any new solution, be it a product, this always comes into the picture, a green premium which has to be paid. So how do you look into it from the advisory perspective? How are the clients managing it? And from the entrepreneur perspective also, Karthik, what are the views around it?
Yeah. So that depends now on the criticality of products, but we see a balanced approach. Some of the clients, are okay to provide a green premium, basis their net zero targets or roadmaps or their corporate sustainability requirements. They do provide 5 to 8% premium on certain products, but there are clients, basically they do a market evaluation and they look for alternative products first, via benchmarking, and see what is available out there in the market. Do you have any alternative suppliers with reduced intensity products. And in that case, yes. So how is cost looking like? So they do a market analysis first, and in case there's a challenge, in terms of availability, then they shift towards green premium. Is what the trend is looking like.
Yeah, my 2 cents would be that at least, and this is again a perspective that's limited to India for the most part, that in India, unit economics is trump and cost is trumping everything else, right? I mean, if it's helping you save money, if it makes a compelling economic argument, it'll find adoption. Willingness to pay a green premium both at the consumer side and even at the enterprise side is actually very low, at least in my limited experience. I could be wrong. It's obviously we've interacted with a fairly small set of enterprise customers, but I'll give you an example. So, for instance, if you look at a lot of our customers are contract manufacturers for, or basically supply chain partners for European headquartered product companies, like switchgear industry, for instance, has a lot of European brands in India, ABB, Siemens, Schneider. Now, those are companies which are headquartered out of countries which are very, very strong on their ESG commitments at the corporate side also, right? And these companies typically mandate their entire supply chain to start reporting on their, kind of, carbon footprint, their current ESG initiatives and their plan forward. Uh, and wanting them to kind of, lap up some of these clean energy solutions as a part of their ESG offset. Tremendous reluctance when the mandate is coming purely from top down, that okay, this is a green practice that we require you to comply to. I have not seen the willingness of these companies or these principals to pay a green premium to these companies, because it's cutthroat competition in terms of uh, even the price points that so they want these companies or the supply chain partners to implement these technologies, but the willingness I've not seen to pass on any premium to them. And for these partners or these contract manufacturers who are feeding into these companies, the desire is zero. The desire is primarily, okay, if it is helping me cut down my energy bills, I'm all for it. If there is some honestly sustainability angle, I found in general, at least in the Indian context, there is significant reluctance. So I feel that I think the best sales pitch for sustainability and clean energy in India has to be around unit economics. Otherwise, it won't fly. At least not in the near medium term. At least, I'm hoping that collectively we can get to a place wherein we all start consciously kind of but we'll have to be real and pragmatic in terms of how we operate as a country and where we are in terms of our own journey. But again, caveat is this is my limited 20, 30, 50 interactions that I've had. And I'm extrapolating that, but maybe I shouldn't paint everyone in the same brush. Maybe it's different in different industries. But our experience has been this.
Yeah. Actually, I'd add to that. It's exactly the same. You're absolutely right. Even in other jurisdictions, it's really about unit economics, how much you're saying. Yeah. What the saying is, show me the beef, right? so
Yeah.
so yeah, and it's true in a lot of other places. So it's not just India, Karthik. I
Yeah.
totally agree with your points.
Thank you so much. Now I will be taking few questions from the audience. Audience, if you have more questions, you can raise your hand or you can also drop in Q&A. But I'll just start from my screen. So, can you give examples where technically strong clean tech solutions failed because the GTM wasn't thought through? Anyone who wants to take this question?
I can take it actually, and of course, we have lots of examples of lots of failures. So, in fact, I wouldn't say, oftentimes, you're not planning and thinking because you're doing a bunch of experiments and you're hoping that some of them will find more traction than the others. So back in about 15 or 16, we were working on this back at that time, very innovative project, which was really a mobile irrigation unit. So this was I'm sure for those of you who are in India, you've seen an e-rickshaw, right? Like a battery operated. So this was an e-rickshaw retrofitted with foldable, collapsible solar panels and a monoblock irrigation pump mounted on it, right? So the premise was that even with subsidies, a lot of the low-income farmers cannot benefit from solar irrigation because uh, even after the subsidy, which is fairly high, 70 to 80% in certain states, they don't even have the capex to fund the balance 10-20% on the solar pump, right? So why kind of leave them out of the umbrella in terms of benefiting from very affordable and reliable irrigation? And the model was very simple. It was like the analogy would be an Uber for irrigation, that you had an app. These were very localized, assets concentrated in a certain area. And you could basically call someone, okay, whenever it was your day of irrigation, because irrigation is not something that is done every day, right? Typically 5 to 7 cycles of irrigation, ballpark, per crop, right? And of course, if it's vegetables, it's slightly more high, more frequent. If it is cash crops, it's slightly lesser, right? So average is 7 cycles of irrigation, each cycle lasting 2 to 3 days, right? So in an entire season, it's not an everyday thing. So there is room for asset utilization and asset sharing between multiple farmers. So that was the premise, right? Now, a lot of fanfare around this, of course, very cool looking, intervention made for great press coverage and so on and so forth. But two things. One, I think the business model itself kind of, was contingent on someone funding these, retrofitted e-rickshaws, right? Now, we were doing it out of some grant capital that we had raised, but it made absolute sense from a farmer standpoint, but we did not pay enough attention that we eventually had to find lenders who would buy into this business model and start giving us some sort of financing for us to scale up this model, right? Now, today, for instance, you can actually lap up any amount of money if you want to set up a fleet of EV cabs, for instance, right? Because the industry of automobiles and the industry of EV cars and the industry of leasing for fleets or cars are fairly mature industries, right? The ecosystem is ready for all of this to come together. Now, imagine going to a lender and saying that, okay, we have explaining to him this concept that, okay, there is this e-rickshaw which has been retrofitted with the solar panels. This has a pump on it. How do you do demand aggregation? So the number of fronts on which you have to basically kind of, solve for someone underwriting your use case is something we did not think through, right? We just got carried away with the innovation around the offering itself and went all in without solving a very critical piece. And of course, it was a spectacular failure.
But that's a very good learning, and it takes back to the points which Vinod and Prof. Paolo have mentioned before. One is, yes, we are at times we become very passionate about a solution, and it is solving a problem, right? It is not a solution in air. But have we validated it? If we have that validation, then maybe selling it to the lender, to the provider becomes easy. And second, who will pay for it? Maybe consumer who is getting the benefit is not the payer, but finding that right language which the
Yeah.
farmer would understand to lend that money, it becomes very critical.
Mhm.
I have another question on the panel. From the market adoption perspective, how do policies such as subsidies, mandates, and carbon footprint regulations impact the timing and order in which different consumer segment adopt the clean tech solution? So again, Karthik, you briefly touched on this, but you and anyone else can build onto this question.
So, I mean, just to build on it, I feel that, and again, as an entrepreneur, we have found merit in always having not, I think, putting all your eggs in one basket. Because, for instance, the role that subsidy played for solar rooftop in 2015 to what it does today is very different, right? So, in that sense, it is not that how policy intervention, mostly in the form of subsidies, or at least unlocking a concept like net metering, for instance, which again is a policy intervention, would do for an industry is likely to evolve with time, right? And typically, what happens is once at least the premise always is that the policy is only to stimulate early adoption, and once the industry, from an adoption standpoint, reaches a certain critical mass, it should be able to kind of find its own 2 feet. Uh, and oftentimes it doesn't happen that way, right? For instance, today I could make an argument that no need to subsidize solar rooftop anymore, right? Even at a 2 kilowatt standpoint, right? But can't wish the subsidies away, right? I mean, it's the mandate of the government and how they are thinking. For instance, of course, now everyone's in this kind of, the reason why residential solar rooftop is being lapped up by the government is because of this kind of, still obligation to now provide 200 p of electricity. So they've reimagined this that of course they don't have the capacity to fire up more coal plants. So they're saying, okay, let's please subsidize a 2 kilowatt system, which roughly generates about 2-3 units of electricity a month, and that's the math, right? So, but the industry does not need that subsidy because it has already reached a critical mass. The technology is mainstream. There's enough adoption. There's enough latent pent-up demand. And in that sense, it has outlived its, but it is there. So I, as a company, have to ensure that my business model encompasses this subsidy, which today is not required fundamentally, because the unit economics at all levels, both at a lender level, at an end user level, and at a company level, are all sorted. So in that sense, these are variables which are not in your control. They'll be very, very volatile. We've had years where in 1 year we had a bumper year on solar irrigation because 5 state governments lapped up the policy and said, okay, we will throw our money behind it. And the next year, almost except for one, all of them basically kind of completely pulled back. So from the market being, let's say, 100 in year one, it went down to 20 in year two, right? So it's very hard to plan your business around that, especially when there is too much policy intervention. But it's again, it's like the good, bad, and ugly of everything. So, it's that aspect.
That makes sense. And we are in a VUCA world, like EV, everyone were talking about EV. First, it was like, oh, we want to explore the technology, people bought it. Then subsidies came, financing came. And now people are buying EV, at least in Philippines. I just yesterday saw a promo going on that you change your gas car with EV for a very high subsidy amount because gas prices are now high. So it could be policy intervention, it could be market demand, or it could be some external factors which either pushes your customer demand or your product demand. So that is something really variable which is happening.
Yeah.
We have a
Isha,
question. Sorry, go ahead.
Isha, maybe I guess to add to that, no, because
Sure.
a lot of the technologies are dependent on ecosystems. And yeah, even to your example of EVs, EVs are great in concept, but you don't buy an EV just to buy an EV, right? You're actually buying a whole ecosystem, charging stations and the whole suite, servicing. You're buying everything. So it just reminds me of this quote by Mark Andreessen. He goes, there are no bad ideas in technology. They're just bad timing." So subsidies are one thing. Maybe they accelerate certain adoption, but they target one part of an ecosystem. So yeah, it's a little bit pessimistic, right? But you want to be building an ecosystem, and yeah, there had to be a lot of subsidies across the whole ecosystem to jumpstart something really quickly, So I guess in terms of EV adoption, it's really complex, right? So, just that EV example, a lot of things have to go right. Well, partly maybe high oil prices are contributing to it. Charging stations have to be there. The whole suite has to be there. Parts availability, that whole thing. Because, by itself, targeted interventions address one pain point, but it's a whole thing, right? It's a whole thing. And sometimes it takes time, right? Just like what Andre said, it's just bad timing sometimes. So the first isn't always gonna be the one that's gonna survive, right? So I guess just to add to the point of Karthik.
That really makes sense. Like it's a whole system. There are different moving pieces. What will work? When it will work? We can estimate, we can guesstimate, but at times things are really out of our hand.
Yeah.
We have a question specifically for you, Vinod. It is from Eric Prakash. He is an aspiring professional in renewable energy. To what extent do cleantech startups support new ideas? And what opportunities do you provide to young minds to help them establish their own firms?
Okay. Yeah, I mean, I briefly mentioned this point in the beginning. Maybe I can, for the sake of the question, I'll repeat what kind of activities we do. So, I mean, we always aspire for the new ideas, new innovations. So, if anybody is having, even it is from the academy or anybody from the industry who is having a startup, we filter those ideas once they approach us. We have a screening process, and we also see the kind of technology which is relevant for the sectors. And we also have an internal the jury of panel from different expertise, and we evaluate with them, take their valuable feedback, and if it is really worth, and we also run the presentation with the different industry members to take the feedback. And finally, I mean, we have a programs, different programs. One, if you are already established, we are giving you a reach out to the industry. So that is called Accelerating Clean Tech Entrepreneurs. That is one program we run. The second program, the specific to the question you have, the Eric has put, if you're having innovative ideas, you can apply in the startup funding program. It's called Ascent, which we have launched in 2025, and we have already announced first cohort in the month of January. They are working on it. There are about 10 technologies which are going for the demonstration, who have already developed a prototype. They will be doing the pilot demonstration in the industry. So we help them to for the expenditure which they will be making in making the pilot demonstration. So if you are that level, we'll be happy to take you if the technologies, of course, if it is relevant to the industries, we'll be taking you. And I think further in continuation to that, we will also reach out to the maximum industry so that you are commercially established and you become the well-established company in the country. So we do the support from the beginning to the end. You develop innovation till you reach to the commercially deployment case. So we'll be happy to assist you. You can write to me. I'll be happy to support you on this regards. Yeah.
Thank you so much, Vinod. Eric, I would request you to reach out on LinkedIn, and that would be a channel where you can connect to. I will just do a quick time check. We have 7 minutes before we will wrap up the webinar. I see a lot of questions are coming in the area of hydrogen and carbon removal technologies. Any panelists you would like to take a question on hydrogen? So basically, we would like to understand, how do you see hydrogen as a future solution coming up in the market? Of course, like Prof. Paolo mentioned, any solution coming into the market is not only about the solution; it's the infrastructure, it's the financing, it's the it's a package. You need the entire ecosystem in order for us any technology to come up and take place. So when we talk about hydrogen, what process makes it feasible? How does it help with net zero targets? Is it affordable in terms of capex, opex? Are some of the questions which we are seeing recurrently in our Q&A panel. Anyone who would like to talk about carbon, hydrogen? To my audience, I would like to bring in our focus for this webinar is CleanTech. We also have dedicated webinars focusing on hydrogen and carbon with the experts from that background. So I would also request you to please join those webinars, or you can reach out to us with your questions and we will respond to you after discussing with the right SME who are focused on carbon and hydrogen.
With the brief discussions that we are having with the clients, I can just add something. So, I mean, clean tech doesn't fail because of bad technology, right? It fails because it doesn't fit how businesses approve capex and their plans. So, hydrogen and CCUs with their paybacks extending way beyond 7 years. So, currently the focus of board is they have clear mandates. Get me a solution having paybacks below 4 years, 5 years max. Get me IRR hurdle rates around 12-15%. So this is where, I mean, the planning starts, and the road mapping starts. So for such solutions, especially H2 and CCUs, though they go beyond these numbers. So only heavy industries are looking at it. And also I'm seeing clients are hesitant because as highlighted earlier, it should not hamper their operations. So they want to take up a small pilot before, and once that is successful, they would want to scale it up slowly. So that this is what we are saying.
Thank you, Chetan. I will be taking one last question, but before we take that, our team would be sharing a quick feedback form for the audience. Do fill the form. It helps us understand what topics you want to hear in and help us bring more relevant webinars to you. I think I will ask this question to you, Prof. Paolo. In the context of funding and capital structure, how can public-private partnership guarantees and okay, my question moved away. Guarantees and green bond framework help de-risk a project. Can you please explain real-time examples around these type of mechanisms?
Yes. So actually, that's an interesting question. The involvement of the public sector in terms of green technology is very helpful in the sense that if they provide certainty, which goes back to what I've been saying a while ago, right? You have to be able to have certainty of cash flows. And if public sector involvement uh, uh, gives that a type of environment, it's very helpful. No? In terms of funding, although this one I'll just digress a little and I'll just talk about something that we've done here in the Philippines. It isn't exactly what you're looking for, but it's an interesting concept as well. No, um, so the Asian Development Bank came up with the idea of an energy transition mechanism, right? For if in general, so this is a global concept whereby uh, power companies or power generators can obtain funding to build new renewable energy capacity to phase out existing, say, coal plants, right? So that funding will replace existing capacity. So and this was an idea developed by the Asian Development Bank. Uh, I guess the end result, yeah, the end solution supposedly was some combination of the involvement of the multilaterals, governments, and power generators. So that idea seemed interesting enough to one of our clients, AC Energy, where they said, "Look, why don't the funding coming out of the multilaterals might take a little bit of time, but we think we can execute this right away." So taking that idea, they developed a purely market-based, private sector-led energy transition financing that basically transformed the capital structure. So, the usual capital structure of debt and equity. They compressed the equity part, then took out their equity from that compression, uh, then replaced it with debt and preferred shares. And it worked because power generation typically has stable cash flows. You have a predictable tariff, you have a predictable power generation. And this is to replace a coal plant, right? So the coal plant is predictable, tariff is predictable, there's a useful life of the coal plant. So you were able to model the cash flows. Lenders were okay with it. And modeling the cash flows to the extent that you cut the useful life by 15 years, right? And the IRR still work. So and then you just divided up the cash flows, right? So one goes to the debt tranche, then they were able to create a preferred share tranche, which would serve as the equity, and then a sliver of small equity for people who were willing to hold on to the coal plant on a common equity basis until they retired it early. And then they were able to raise funding for all of that uh, to replace that coal plant early, 15 years early, with solar and other renewable energy uh, assets. No? So that one actually closed. So we were able to do a deal or several tranches of a deal to raise about 290 million US dollars to phase out that coal plant. So the coal plant's still operational. But it will end early. Now, the question is, oh, for the funders, I'm lending you and the cash flows are coming from a coal plant. It's still coming from a coal plant. But then we were able to, the lenders became comfortable enough to say, look, we're really lending to a coal plant, fine, but we're lending because we need a capacity and you're cutting the useful life of that thing significantly. And we know the use of proceeds will really be to replace that capacity with renewable energy. So it ended up that that transaction closed. It's the first market-based energy transition financing in the world. Now, while the multilaterals weren't able to participate because of the timing considerations, we credited ADB saying, "Look, this was your idea. We executed it, and it works." So hopefully that model serves as something that can be replicated in other parts of I guess developing Asia. No? So it's there, it works, and it's maybe one of the solutions that we're looking for.
Yes, yes. And these type of blended and innovative financing would be required again, because price sensitivity to how much a person can really pay is a questionable thing. And how do we get right funding to bring these solutions to the market to reach the right audience would be a game changer when we want to do such a large scale of, be it decarbonization, renewable energy kind of projects. With this, we are over time. Thank you so much, all the panelists and audience, for that active, lively interaction. I really hope each one of us has a good takeaway from the session. Clean tech solutions, sustainability, green choices, these are not any more choices, these are the mandates. It could be coming through policy, through the market demand, through the competitors, or through the consumer pain point which we are trying to solve. When it comes to a new energy or new solution coming into the market, we need an ecosystem, infra support, financial support, innovation, innovative financing. Any solution going to the market better have those assurance, validations done so that you can sustain it for a longer period. A very good idea would still need a backing, will still need a consumer, and will still need a market to take it up. So I think this has been a very good session. Thank you so much, everyone, for sharing your views and for being with us.